I'm so glad Kun Sombat could come today with all the team leaders. It's, I confess, quite an emotional moment for us after so many years. So thank you for, they came all the way from the provinces to be here for just this event. Okay, so my job right now is to try to, in some ways, summarize the conference. I will not try to do that comprehensively, but rather selectively with some examples to provide some unity and also instead of thinking about all that we've done, also think about all that's left to be done and move forward with frameworks that are useful for Thailand. So this is very much in the theme of research with the data, the use of theory in particular, and recommendations that come from theory for policy. I'm going to focus on two topics: liquidity and the design of payment systems, and monetary policy as one topic, and financial intermediation, electronic platforms and regulations will be the second topic. In each one of these, I will talk about theory, data, and policy recommendations. And if you'll forgive me, I will, along the way, add some special notes of the relevance and recommendations for Thailand and come back also with a summary for that at the end. So liquidity and the design of payment systems and monetary policy, the first topic. These micro-founded general equilibrium models of liquidity and money provide rich frameworks that we can use to understand the meaning of institutions and markets, and also for organizing and analyzing data, and then have important operational implications for the design of payment systems and for monetary policy. So this is one of the slides that provides a partial summary. In fact, Antoine talked about almost everything on this slide. The caption at the beginning, motivation from the U.S., from the Federal Reserve balance sheet to the impact on micro markets. So it's from the top, from macro on to micro. And as Antoine was saying, we've seen in the U.S. the expansion of excess reserves and the balance sheet of the Fed, and it's had direct implications for intraday credit, I'll add, apparently for improving or minimizing trade fails. The conversation in the U.S. used to be about liquidity savings mechanisms in clearing, and it has now gone to a conversation about segregated balance accounts that can be used as collateral, really, for borrowing. So it just reflects, the change in conversation reflects a very different reality that came from this expanded balance sheet. There is a literature that links payments to monetary policy. I would say it's sparse. There's not much of it, but it is quite important, and varies within it in terms of the degree of explicitness and the frameworks used. So, for example, the Bank of England has very good publications and speeches about payments, but really avoids linking payments to monetary policy. It's viewed as a separate important function. The U.S. Federal Reserve goes a bit further, in particular, opened these primary dealer credit facilities to provide liquidity during the crisis, and that was a substantial part of the increase in the Federal Reserve balance sheet for a couple of years, although it has gone down more and terminated, actually. Then there's an academic literature and I won't name all these names. You can see from the titles of the paper the intimate interconnection between payments and monetary policy, and then I add at the end sort of micro-founded industrial organization models that look at the implementation of monetary policy in the New York markets and also out in the regions, depending on the structure of banking competition out in the regions. Now I'm going to switch gears and go from below, the motivation from developing countries, from the micro back up through financial markets and really on to the macro. So this first slide as motivation comes from India as a developing country in the 80s, and using these ICRSAT data, my co-author and I, Young Jae Lim, created a payments matrix so we can actually see what objects are exchanged against other objects. It's not typical to have these data, although more on that momentarily. And if you could see the small print, you would see that although money is the most frequently used thing used in exchange, grain is used to pay labor, and there is borrowing and lending in grain. More typical experience, and again, this came up earlier in the conference, is typical cash economy. So these slides that White presented in part, looking at the inflows and outflows of currency for a somewhat typical household and the net accumulation of cash in the house as an example of, let's just say, cash management that would seem to be subject to approval. And the top slide over there is at the village aggregate level, where everything is netted out across all the households in the data, and there you can see the net deposits and withdrawals are really minimal, and it's safe to say at the village level, cash is really the one and only thing that is being used as the payments, which, as you can imagine where I'm going, has a lot to do with thinking ultimately about monetary policy. We have seen innovations in the world, in particular e-money and e-payments. This is, of course, very much part of the Thai plan to improve the payments system, fast payments and so on. Thailand is not alone. Building on the experience of other countries, the idea is not only to do payments, but to get to credit and insurance once people have access to the financial system through the payments devices. Kenya is a widely cited example, really one of the first, where a cell phone company allowed people to exchange Kenyan shillings, the currency, for credits on their cell account, which could then be used to buy and sell and transfer to vendors and other households. This graph is showing you the utilization rates on average, and also for the low-income population in a country that is not rich to begin with. And those rates of utilization of M-Pesa are up to over 90%. So it's really quite a stunning transformation of the payment system in that country. Now, this little schemata is telling you just a bit about how it works. The key institutional feature are these agents, which are entered into contracts with Safaricom, the cell phone company. These are small gasoline stations and vendors where people can go and exchange their shillings for e-credit, and actually also cash out, exchange their e-money, the M-Pesa, back to cash shillings. And so there was a survey of these agents, broker-dealers really, of whether they ever run out, and many of them are running out frequently. They're not able to meet the demands of customers for the currency that the customer wants if they're cashing out, and also they actually can run out of the sell credits. Now, in this system, there's no net creation of additional sell credits. It's essentially a one-to-one exchange with the transactions cost, although you could very well imagine electronic money where there is net creation of credit in the system. But as you may see where I'm going, when I use the term broker-dealer, there's a unity in this which brings us back to the New York markets. Agents are go-betweens, buying and selling, doing repos, security transactions, and so on. Here I say a common view of institutions in the U.S. and in emerging markets get ahead of coming problems, guidance for Thailand. If you do not have these problems now, you will experience them now. They are common to New York, Kenya, and so on. And there are institutional forms that deal with them. This first paper is about providing liquidity in the interbank market, lending relationships. There's a paper here on click and call as an electronic way to organize little mini hybrid markets to try to match buyers and sellers and other arrangements. So these are the institutional forms that you can expect or hope to see, and that's why I use these words, get ahead of it. The other view of unity here is in the measurement. This slide, again, summarizes things that have already been presented in the conference. This is the book with Chris, Households as Corporate Firms, where we talk about the balance sheet, the income statement, and statement of cash flow, and how to do that for households, in particular running farms and small businesses. Scott's work from the Boston Fed, he presented on the diary and the survey of high-frequency measure and how they have come together, these two strands. It's unified in practice, in other words. It's not just financial accounts for Thailand and payments for the U.S. They're now married in an innovative way. Scott presented this slide, so I guess I will not dwell on it. It's a summary of liquidity flows or account flows that measure all these payments devices, and this can be done. And in fact, there are meetings this afternoon here at the bank to talk about the next Thai payments survey. A little bit more on the common framework for measurement. We're talking about an integrated view within economies. So we can talk about flow of funds, of villages in terms of currency and credit and other securities that flow in and out of the village, just like we can create the flow of funds for the national level accounts in a standard way. And here it happens to be geography. One could choose other ways of zeroing in. And again, the recommendation here, consistent with the theme of the conference, of the session we just had, is to continue this kind of measurement. We did encourage and partner with the NESDB in Thailand to try to create more information on the geographic flows. I hope that project is moving along. So again, an operational recommendation for Thailand. So we need unified theory also, not just measurement and a common view of institutions. The idea is to look at transactions costs, which include obstacles which include transactions costs, random market participation, limited communication, information, complexity, spatial separation, and so on. Put these several ingredients in a model, and then do a thought experiment, which is, if the world were like this model, what, with these obstacles, what would we learn? then try to match that to episodes in economic history or episodes in one country or another, developed or underdeveloped, feature the measurement that the model is suggesting would be key. Obviously, ideally, get data and see whether it's fitting well or not, and maybe get some guidance for what kind of data could be and should be gathered to test the logical implications from the framework, and then follow up with the policy recommendations that the framework suggests. This is a cheap way to think about problems that can emerge. The logic, which is a complement to what Antoine was saying, the details of these institutions and markets matter. I guess I also want to say Antoine was emphasizing knowledge of the institutions and so on, and actually how these can be constraints on policy. But that's perfectly consistent with the view that we should not set up new institutions that can subsequently be a constraint on what we might want to do in those circumstances that have yet to arrive. To the extent that Thailand is now thinking about the design or redesign or innovations within its financial system, this is a time precisely to think forward, not just to do one narrow thing at a time, however compelling that might be, but to think about the consequences, which are innovation today are going to be legacy systems for tomorrow, and you want to sort of try to make sure you have the right institutions tomorrow. So then there are 4 topics that I'll quickly cover that come from theory, sort of lessons learned. The first is risk in liquidity and clearing, deferred payment and credit, trade fails, penalties, and systemic risk. So here the idea is that if you're a buyer before you're a seller, you're kind of running a deficit. In historical systems that we've seen in England and the rise of trade there, the way they operated their trade fairs with bankers and units of account, they kind of avoided this. They had deferred payment, which solved this problem. But other ways to do it would be allow the debtor to borrow to another day or another period, or issue a promissory note like a bill of exchange, or unfortunately default. And we do see in the U.S. default in the sense that there are failures of trades in treasuries. Are there remedies? How could we prevent this from happening? Go to theory. Do a logical experiment, as Dubé was doing, to implement a Walrasian outcome. He has a way of setting up the design of markets with penalties that allowed full implementation. Related things have to do with systemic risk in payments, computer science notions of complexity in payments. So, and these studies are conducted by commercial banks. So, it's not enough to say, well, we have, botnet and it functions really well and it's not a problem, because the experience in other countries is that you really need to run these systems, and especially as the payment system is changing in Thailand, one has to think through where shortages may develop and how to deal with temporary imbalances. So that would be an instance of using theory as a conceptual framework to think through the current Thai system and also where it may be going in the future. And likewise, the recommendation is to begin now to do the measurement. The central bank has a lot of data on payments, and that could be organized in a way now, starting now, to think about the potential evolution in the future to try to mitigate some of these problems. innovations in financial systems, e-payments, and monetary policy. This is about limited communication as the obstacle, about the difficulty of complete record keeping. There are papers, theory papers in the literature that recognize that the issue isn't simply sufficient liquidity, it also has to do with the coordination of trade and the information required to allow trade, and that information is often more centralized, although with the coming of distributed ledger technologies, it's now easier and easier to think about new systems, and we are seeing this innovation initially at the retail level with Bitcoin, and now in New York and other places at the wholesale level among these large value institutions. I actually don't know yet whether Thailand is using distributed ledger technologies, but it's certainly something to consider. High velocity private debt, high velocity public debt. When you have obstacles like spatial separation, it's good to allow securities to circulate. They become something like a medium of exchange, hence you could call it privately issued money. That can be a good thing. The theory tells us that, but the theory likewise alerts us to a problem which is a coordination problem. Spatially separated markets needing to somehow coordinate in the issue of the securities which will eventually circulate. And if the coordination does not happen, there could be a potential problem. One could speculate that the financial crashes in England in the bills of exchange market actually came from this problem, and that actually gave rise to the Central Bank of England. So again, Thailand going toward fast payments, potentially private debt, or for that matter, public debt that has very high velocity, so one could be alert to this problem which may emerge. And notions of financial centrality, again, widely used in regulation. The worry is all the interconnectedness among the banks. When one fails on a promise to pay, it makes its way to its creditor, who in turn, not getting the money, fails, and you get these chains or these cascades. This has caused many central banks to try to do these network pictures measuring who's financially central, where's the systemic risk, which players, if they went down, would bring much of the rest of the system with it. But if you take an ex-ante perspective, some of the links across traders are good because they allow risk sharing, and they also remind us that an economic notion of financial centrality has to correct for the provision of liquidity. The most central people are people who are not necessarily in the market all the time. They're people who arrive with liquidity when they are needed most, which is when the market is thin. This is a very operational notion. It can be used, although it has not yet been used, say, in the European interbank market. Ironically, we've taken it back to the Thai villages where they have this active money market, and we're turning up evidence that key players in this financial centrality sense are compensated in the sense of having higher average consumption. So this is kind of a telling, if not amusing, story that, how sophisticated are the Bangkok money markets, who's financially central there, have Thai villagers figured stuff out implicitly in their own sort of informal credit markets that is reflective of this concept. And we turn to the subject of financial intermediation, e-platforms, innovation and regulation. Here I want to display attention, which is really just huge in Thailand, but also typical in other countries. We had a crisis in the US and so on. Then there's enhanced regulation, sort of a language and policy conversation around non-bank financial institutions, shadow banks in particular, often with the idea that it must be bad because it seems like they were not regulated and the way banks had been, and that has been argued to be one of the causes of the crisis. On the other hand, the twin side, we're facing financial innovations with new technologies, not just in payments, but also in the financial markets, non-bank financial infrastructure. This seems like a huge opportunity. There's something in between, which is that some of the innovation that's happened in some countries in the guise of e-payments and fintech is actually not using the new technology so heavily, but rather seems to be an innovation that somehow has been allowed in the context of the previous regulation. That begs the issue of whether or not to allow it. I guess I would argue that, in fact, it may be a good thing if the previously legacy systems and regulations were inappropriate for the new economy. We should embrace the new technology and have regulation that is appropriate for that new technology, not the old regulation that may be impeding the innovation. What kind of regulation? Hey, use economic theory. It provides the guidance that we need from first principles on the design and operation of e-platforms. Now, this is very much prescriptive rather than positive. It's providing blueprints. We can look at institutions and data and decide whether, as a first approximation, the system is already working well. And it also highlights the kind of data that we need to make those judgments, which both those comments very important for Thailand. Now again, we could go through some motivation here. I'll try to summarize this. In the US, we have had that crisis, and it has led to this tri-party repo and new centralized counterparty platforms, where it is thought that these platforms are good because they provide transparency, liquidity, netting, and reduced risk. It's a very compelling case, I would say a very seductive language. It's kind of hard to criticize it. If you dig down a bit, you will see people arguing more specifically that the good thing about these central counterparties is CCPs is that those institutions exhibit network externalities where the value of one person on the system is a function of other people on the system, either the same type or the opposite type on the other side of the market. That these CCPs exhibit important economies of scale, that somehow the interfaces, clearing platforms, database engine, and so on have fixed costs and create increasing returns. That in turn suggests that we might want to have just one platform, but brings the question of who's running the platform, and Daryl Duffy and others have argued that some of these ought to be regulated the way public utilities are regulated. The method of judgment here are these key elements in economic theory. Again, externalities, economies of scale, and market power. So those are the things that we need to keep our eye on in actual markets. Now, on the other hand, in the U.S., there is another flip side, which is the view that fragmentation, at least in equity markets, has arguably been a good thing. These authors note the rise of electronic communication networks, alternative trading systems, the trading desks of broker-dealers, and argue that trading speed has gone up, transactions costs have gone down, and there are other measures of efficiency according to the way prices are behaving. So this is the view of having multiple platforms, not just one platform, and the idea is that each is like a portal or an entry point into the larger market, so that we should not necessarily think about just having one platform, but how the platforms are interconnected in terms of what economic outcomes are accomplished. China looms large in so many ways. The expansion of e-commerce there is huge and growing at a very fast rate and actually expanding in a way into smaller cities and even potentially into rural areas. I won't review what you already know about Alibaba and these business-to-business platforms. We have as well business-to-consumer platforms, consumer-to-consumer platforms. But many of these marketplaces in China have failed. There's been a fair degree of fraud and failures, and the information system that came with the borrowing and lending seems quite limited. So here I'm using institutional facts, really, and unfortunately we don't have even the new sort of Chinese PSID survey of consumer finance surveys the sample is too thin, and they weren't designed in a way to actually see the impact that these platforms are having on borrowing and lending. That is a comment for Thailand to get ahead of it, get the measurement in place as these new innovations come online. China's reaction to the failures was to basically try to severely limit the market activity. The idea would be to have registration, not allow securitization, limit the amount of loans in one or several platforms, don't make implicit or explicit promises to investors that they'll get their money back, or guarantee to borrowers that they can continue to access loans. Now, the theoretical frameworks actually take us in the other direction, my point being that the Chinese regulation, which is, oh, we're so scared, let's shut it all down, didn't come from a thoughtful reflection of economic theory and the guidance that could be provided. So platforms can be the opposite, actually, of simple pass-throughs. They can be active go-betweens in managing portfolios, in information control, and in securitization. And I have more to say about that momentarily. There are innovations in Mexico and India that I talk about as piecemeal, not to take away from the important nature of it. TREDS, your virtual next-door neighbor in India, has an electronic platform for accounts receivable where small businesses who are owed money by a large, more reputable company can sell their accounts receivable to factors or to investors. It's somewhat similar to an innovation of Nafin in Mexico. I think Thailand may have tried to create these accounts receivable platforms. It hasn't worked so far, but the experience of India and Mexico suggests that it might be possible. I'm actually somewhat helping the Central Bank of India to evaluate the TRED system, but one of the problems is, again, data were not gathered along the way. Go back to the U.S., full circle, after this tour of developing countries, we do have marketplace exchanges like Lending Club and Prosper for consumer debt, but also student loans, small business lending, and so on. I'll spare you the detail of how those platforms are run in the U.S., although the details are here on the slide. And then in terms of the regulation, please do not look to the U.S. as a role model of how to regulate these platforms. There are like 17 federal agencies or something like that. There's multiple state and federal agencies that think of these things as borrowing and lending and worry about consumer protection. There's another view that they're really securities and the SEC is involved and so on. And even to this day, there is not an accepted framework for regulation of marketplace exchanges in the U.S., although the Office of the Comptroller of Currency has proposed to be. And another point I want to make, and I know this from experience, the amount of data that they have about households and small businesses and students and so on the ground is quite sparse. The data that get used are data that say are even public and provided by the platforms. You can see the electronic commerce on the platform, but you don't know who's selecting to be in there. And apart from credit registry, which is pretty good in the U.S., you know relatively little about the underlying customers. So again, the lesson for Thailand, you know, my surveys with Kunsombat and other types of surveys would seem to be an integral part to keep going in some way as these platforms develop to provide better information for better design. So the theory here approach is the same. Specify the environment, enumerate one or several possible frictions in suiting the costs, derive the optimal design, think about whether those systems can be decentralized. I will just summarize to say that, again, if you go back to even earlier work in economic theory, we can find some pretty cool blueprints there. These papers were about how to implement Walrasian allocations by having auctions and markets and platforms designed in a certain way. They do pay a lot of attention to the interrelationship across the different platforms in liquidity or in blocking the greed of certain, say, small number of large players. We do have auctions and auction theory. It's somewhat applied to financial markets. The big ones having to do with spectrum auctions, they were designed by Paul Milgram and others with theory in mind. So this is not a stretch. I'm not on thin ice here to be saying that we can and should be using economic theory to help design the new financial markets for Thailand. I'll skip that. And part of the issue is going to be private information. Private information has implications for what you could or should see happening. This has to do with anti-China in the sense of alternatives. You should see flexibility on these platforms in terms of relationship lending if there's private information. You should see information management in the sense that not all the information that the platform becomes aware of should be made public. That's a bit counterintuitive, but it's a big part of contract theory and mechanism design. And likewise, you should expect to see delegation so that exchange-traded funds or cooperatives or wealth managers are actually responsible for taking decisions on behalf of customers. Again, the spirit of China went, the policy conclusions in China went just the opposite way. It's sometimes thought that when you have private information, competitive markets don't work well. That's actually not true. As long as you have the correctly designed contracts and as long as you allow broker-dealers to compete with one another in the appropriate way, you can get to efficient outcomes. Then we come back to the number of platforms, and all I'm doing on this slide is enumerating economic models with their key ingredients that suggest there should be one big massive platform or multiple platforms or certain hybrid arrangements. I will spare you the details, but I do want to make one point here, which is the concern about systemic risk. Part and parcel of what you can do with the design of these new markets is things that T and I have worked on, which is to mitigate the risk of fire sales and repo spirals and so on. If you have existing institutions, it's hard to innovate. If you don't have those institutions yet, this is a good time to implement this kind of design. And likewise, you can think about supervision from the point of view, bank supervision, rotating bank supervisors and so on, with some guidance from theory. We've gone through my project, the Townsend Thai project. Recurrent theme in this program with the data gathered by Thai Family Research Project and Kun Sombat and his team. These are just maps of where we've gathered the data. There's an interesting episode in Thailand having to do with the coming of these village funds and a very increasing understanding of exactly what did happen. They did not operate in isolation of the informal transactions that were there. It now appears that they actually built on family kinship arrangements, especially for households that did not borrow from the village funds. My point being that that's not an electronic platform, but you could expect when the new wave of marketplace exchanges arise in Thailand that the informal sector isn't necessarily going to go away and should be thought of as part of an optimal design. So, design of financial systems, how would one design a system? Factors to take into consideration. It's very tempting to look at the experience of another country. Pick one. Pick your favorite. Wrong. There isn't any single country that provides, an example to follow. They all have pluses and minuses with their pitfalls. Instead, what I'm recommending is to use theory and what we know from data to think about the kind of regulatory framework that countries like Thailand ought to have, both to think about liquidity and monetary policy and to think about the operation and number of financial platforms. Anticipate, create a long-run plan, think about problems which theory and data tell us are likely to occur in the future, piecemeal systems, sandboxes. It's an attractive language, but there are still issues about who can play in the sandbox, and there are issues about thinking myopically at the current stage rather than forward-looking. And as the governor was saying in his initial wonderful remarks, Thailand should be thinking in the long run, not just in the short, immediate run. And I've emphasized constantly, and it's been a theme of this conference, the importance of measurement. We need comprehensive mapping that links the macro and the financial markets down to the micro households, SMEs, and back up the liquidity and implementation chain from small to large value players. The Townsend Thai data is a start on this. It's a window into the world of villages and towns that would not be possible without the data, but the Townsend Thai project and the surveys run by Thai Family Research Project are really needing to continue in one form or another in order to guide Thailand forward. So I'm done with my talk, and this is off script, but I really want to thank the organizers of the conference and the Bank of Thailand and the Thai Research Fund for sponsoring the conference. UTCC is also a sponsor, and I hope you have all found the interactions here to be stimulating and useful. I know that I have really enjoyed it, enjoyed the panel and the papers quite a bit. So let's thank the organizers. These things are a lot of work, and we appreciate it.